Hi there, John Bowens with Equity Trust Company. In this segment, we're going to be talking about the 2019 contribution limits for the 7 tax-exempt or tax-advantaged investment accounts. And all of these accounts you'll learn are self-directed. Self-directed in the sense that in addition to traditional stocks, bonds, and mutual funds, you could also invest in real estate, private lending, real estate private equity, precious metals, and a wide array of all other alternative investments. Let's get to the whiteboard. So here's the 7 tax-advantaged investment accounts that we're going to be talking about. The Traditional IRA, Roth IRA, and then there are 3 business plans, SEP IRA, Simple IRA, Solo 401k, and then last but not least, we'll talk about the Coverdell Education Savings Account as well as the Health Savings Account. Yeah, that's right. You can actually self-direct a Coverdell Education Savings Account and Health Savings Account and potentially buy real estate, do private lending, invest in other alternative assets. So let's first talk about the Traditional and Roth IRA. It's important to understand the tax nature of these 2 accounts. A Traditional IRA is a tax-deferred account, meaning in general terms, when you put money into the account, you get a tax deduction for it. It grows tax-deferred, and then when you take the money out after the qualified retirement age of 59 and a half, you then have to pay taxes. In contrast to the Traditional IRA, the Roth IRA, you fund the account with after-tax money, so you don't get a tax deduction. It grows tax-free, and when you take the money out after 59 and a half, you don't have to pay taxes. So as you can see, there's advantages to both the Traditional and Roth IRA from a tax mitigation perspective. So let's talk about the contribution limits. When under the age of 50, providing that one is eligible, they can contribute up to $6,000 to a Traditional or Roth IRA. Now it's important to understand that it's either or combined between both. While under the age of 50, you cannot exceed as an out-of-pocket contribution $6,000. When 50 and over, you can contribute up to $7,000. Now this is for tax year 2019. If you're watching this in a future year, you can go to irs.gov and you can look up this information in real time. Now if you have a spouse, even if they're not working, providing that you're both eligible and that one has earned income, you could also potentially establish a separate IRA under your spouse's name and make a contribution to their account. This is what's called a Spousal IRA Contribution, of course, with that spouse's consent. So with a spouse contribution, they'd be in 2 separate accounts, but you could conceivably get up to $12,000 as a married couple. And if 50 and over, you could potentially get up to $14,000 as a married couple into an IRA in just 1 taxable year. Let's move on to the small business retirement plans. Now with these small business retirement plans, you'll see you could potentially get higher amounts as a contribution in one given year compared to a Traditional or Roth IRA. Some investors have both an IRA, Traditional or Roth, as well as one of these small business retirement plans. Now, just as with a Traditional and Roth IRA and all the account types that we're talking about, it's important that you're consulting with a competent tax professional, CPA, or other financial professional regarding these particular programs. Equity Trust Company is a passive custodian. We provide a lot of information and guidance, but again, it's important you're partnering with those particular professionals. So the SEP IRA stands for Simplified Employee Pension Plan, SEP IRA. It has a maximum contribution in 2019 of $56,000, not to exceed 25% of your W-2 income. So if you're self-employed and you're paying yourself through a W-2, you can't exceed 25% of your W-2 income, and then not to exceed $56,000. Or not to exceed 20% of your self-employment income. So this is where a good CPA or tax accountant comes into play to be able to instruct you on exactly how much money you can put into this particular plan. So let me give you a quick example. Let's say you have $100,000 in self-employment income. So you're filing the applicable schedules with your tax return, you're showing $100,000 in self-employment income, and you're going to use the figure of 20%. So 20% of $100,000 is $20,000. So you have $20,000 put into the SEP IRA, and this is a tax deductible or tax deferred account. So it's similar to a traditional IRA. When the $20,000 goes in, this $100,000 in taxable income is going to be reduced down to $80,000, thus saving you on some taxes in that particular year, assuming that you're qualified to do so. So let's move on to the Simple IRA. Simple IRA stands for Savings Incentive Match Plan for Employees. Think of it as sort of a hybrid between a 401k and an IRA. You'll see it has both an employee contribution and then an employer match. So as the IRS would depict this on their website, you'll see you're wearing both hats as a business owner, an employee hat and an employer hat. So let's first talk about the employee side. So as an employee, when under the age of 50, you could potentially contribute up to $13,000 into the Simple IRA, and that could be up to 100% of your earned income. Whereas the SEP IRA, like we talked about, you're limited to that 20% or 25%. When you're 50 and over, you can contribute potentially up to $16,000 into the Simple IRA. And this is a tax deductible account, very similar to a SEP IRA and a traditional IRA. When money goes in, you get a tax deduction for it, it grows tax deferred, and then when you take the money out after the qualified retirement age of 59 and a half, that's when you have to pay taxes. So that's the employee side. Let's move on to the employer match side. This can be 1 to 3% of your earnings. So let's say you're making $100,000 and you're putting in, if you're 50 and over, let's say you're putting $16,000, which is the full contribution, and then you want to do 3% match. So 3% of $100,000 is $3,000. So in addition to your 16, you have another 3, which is then up to $19,000, and then that would be, of course, all tax deductible. All right, let's move on to the last account, which is the solo 401k. So the solo 401k, think of it as very similar to a 401k that you would have with a company you work for, but it's for your own self-employed practice. It is important to understand to be eligible for a solo 401k, and again, this is where a good tax accountant or CPA comes into play, that you cannot have any employees. It can only be you and possibly a spouse as an employee. And you have to have eligible earned income. So you have to have earned income in order to support the contributions to this solo 401k. So let's talk about the solo 401k contributions. They're just like a simple IRA like we talked about. There's an employee contribution and then there's an employer deferral. So 401ks, when you work for companies, think of that employer deferral as sort of like the employer match, all right? But again, this is for your own business. So as an employee, when under the age of 50 for taxable year 2019, you can contribute up to $19,000. When 50 and over, you can contribute up to $25,000. Now with the solo 401k, there's what they call a Roth component. Roth component, just like a Roth IRA. Instead of putting this $19,000 or this $25,000 into a tax deductible bucket, if you will, and getting a deduction for it, you could potentially defer it into a Roth component after tax money, just like a Roth IRA. It grows tax-free, and after the qualified retirement age of 59 and a half, you pay no taxes. So that can be very advantageous to some investors out there if they're looking for more of that tax-free growth. So now you have your 19, your 25,000 in as an employee contribution. We can move on to the employer deferral. You can defer up to 25% of your W-2 income, or if it's self-employment income, your figure is 20%. So if we use the same example we used with the SEP IRA, let's say $100,000 in earnings, we're over the age of 50, we can put up to $25,000. And again, we can put that $25,000 into a Roth or a tax deductible bucket. And then 20% of $100,000 is $20,000. So that gives us a total of $45,000 contributed to the solo 401k. Important to understand that this employer deferral contribution must go into the tax deductible bucket of the plan. It cannot go into that Roth component. So Combined, if you're paying yourself enough, combined between both the employee contribution and employer deferral, you could potentially, when under the age of 50, get up to $56,000 into a solo 401k. When you're 50 and over, you could potentially get up to $62,000. Again, in summary, that combined amount is between both the employee contribution and employer deferral. Okay, let's move on to the last two tax-advantaged investment accounts, the Coverdell Education Savings Account and the Health Savings Account. The CESA account stands for Coverdell Education Savings Account. The contribution limit for a Coverdell Education Savings Account is $2,000 per year per child, known as a beneficiary to the Coverdell Education Savings Account. So if you're a parent or you're a grandparent, you could potentially look at establishing a Coverdell Education Savings Account to create some tax-free growth and tax-free income to pay for your children's K through 12 education or higher educational expenses. The Coverdell Education Savings Account, very similar to a Roth IRA, when you make contributions, it's after tax, so you don't get a tax deduction for it. But it can grow tax-free through your investments, and it can be taken out tax-free, providing that you're using the money for eligible educational expenses. Let me give you a quick example. A client of ours in 2017, he was named the Investor of the Year in 2017. His name's Brian, and he bought a vacant property for $8,000, partnering 3 of his children's Coverdell Education Savings accounts. They bought the vacant lot for $8,000. CESA number 1 had 50% equity in the deal. CESA number 2 had 25%, and CESA number 3 had 25%, combined 100% total. They subsequently sold that vacant lot to a real estate developer, and they made a $50,000 net profit. That $50,000 was divided amongst those 3 Coverdell Education Savings accounts. So he, on that transaction, made $50,000 tax-free, if you will, to pay for his children's college tuition or K through 12 education. Let's move on to the last account, which is the Health Savings Account. A lot of people aren't familiar, aren't aware of the concept of being able to self-direct an HSA, a health savings account, into real estate, private lending, and other alternative investments. With a health savings account, when you make contributions, you get a tax deduction, assuming you're eligible. You grow it tax-free through investment activity, through buying and selling real estate, renting out properties, private lending, et cetera, et cetera. And then when you take the money out, providing that you're using it for its intended purpose of healthcare-related expenses, it's tax-free. So again, you get a deduction going in, you get tax-free growth potential, and you get tax-free withdrawals, providing you're using it for its intended purpose for healthcare-related expenses. So how much can you contribute to one of these health savings accounts, providing that you're eligible and you have a qualifying high-deductible healthcare plan? For a single deductible, or single policy, if you will, when under the age of 50, you can contribute up to $3,500. When 50 and over, up to $4,500. And then for a family deductible, when under the age of 50, you can see you can contribute up to $7,000. And then when 50 and over, you can contribute up to $8,000. We have seen self-directed IRA investors and real estate investment entrepreneurs will actually partner their health savings account with their Coverdell Education Savings accounts, with their Roth IRAs, or other tax-exempt investment accounts in order to transact business. We hope you enjoyed this short segment. We have many, many more just like this. Equity Trust Company is a passive, self-directed IRA custodian. We're here to provide information and education. We have a lot of videos that are going to be upcoming. We would encourage you to subscribe to the Equity Trust Company YouTube channel. That way, when we have additional videos and content to share with you, we'll send you a notification. We look forward to seeing you on the next segment.